Guys, most investors don't lose money because they're stupid. People ain't stupid out here. But most investors lose money because they just get too emotional. And right now, emotion is starting to take over the stock market. You got this AI hype that's everywhere right now. You got the Fed, who has a new Fed chair. We got inflation concerns that have been going up. And then you got the stock market constantly hitting these all-time highs. All of that is making people react instead of thinking rationally when it comes to the stock market and investing. But the deal is this: intelligent investing, it's always been about discipline. So in this video, I want to walk through 8 rules of intelligent investing that I personally believe matter now more than ever before. Now, the first rule of intelligent investing is this: you gotta master your emotions. That's first. You can't be panicking every time something happens or every time you read a headline. The stock market moves fast. Headlines are all over the place, right? Some good, some bad. Wherever you go on social media, you see these headlines about investing, right? On Fox News, the economy is doing wonderful. But then on ABC or CBS or CNN, the stock market is in trouble, right? Social media moves fast. Regular media moves fast. You in the headlines one day, you out of the headlines the next days. But here's the deal. Intelligent investors, they understand one thing very important. Their emotions will destroy their portfolio faster than anything. And a lot of people think that investing is mostly about intelligence. But for real, investing is more about behavior, if we just being really honest about it, right? Can you stay calm when everybody else around you is panicking, or when everybody else around you is hyped up? Can you stay disciplined? The key is always, when it comes to investing in the stock market, buy low, sell high. But watch this. Emotional investors, they usually end up doing what? Buying high and then panicking and selling low. That's what you don't want to do. The stock market is going to reward your discipline. It's not going to reward your emotional reactions to every little thing that happens. Guys, let me know in the comments below if you've been guilty, and just be honest, of investing based on your emotions, okay? The deal is this: once you understand the importance of controlling your emotions in terms of the stock market and investing, that naturally is going to lead into the second rule of intelligent investing that I want to talk about. Now, the second rule of intelligent investing is simply this: invest with a plan. If your money don't have no instructions, it's just going to wander. It's going to find somewhere to go until you tell it where to go. And eventually your money's going to be lost. You're going to be wondering, hey, I made all this money, where'd it go? So one of the biggest mistakes that I see investors making is they don't have a plan. They don't have a real written, solid plan to follow when it comes to investing. They don't have no core beliefs, what they believe in businesses. They don't have no investing philosophy. They don't have no goals. They don't have no allocation strategy, how much is going to go here, what percentage there, and all that. People simply invest and they don't have long-term direction. They just out here reacting to whatever's taking place in the moment. Intelligent investors know this. So guess what? Intelligent investors, they know what they own. They know why they own it, and they know what they're trying to accomplish. Because when the stock market does what the stock market gonna do, your written plan about how you want to invest becomes your base and your foundation. And honestly, guys, once you create a written investing plan, the next step is understanding the risk that are going to be connected to your plan, which brings me to the third rule of intelligent investing. And that's that most investors just aren't thinking about on a regular basis. The third rule of intelligent investing is always consider risk. Every single investment has risk, folks. I don't care if you invest in a burrito at Chipotle, it's still got a risk. I don't care if you have a high yield savings account, cash, bonds, CDs, individual single stocks, ETFs, index funds. There's risk involved with all of them. The real question though is, do you actually understand the risk that you're taking with all of your investing? How much volatility can you emotionally tolerate? At what point let me just put it like this. At what point would fear cause you to abandon your strategy, right? And go do something totally different. Because here's the deal. Risk is not just math, okay? Risk is also behavior. And sometimes here's what happens to a lot of investors I talk to is people take on a lot more risk than they psychologically can handle, but they don't really realize they have the risk because they've never assessed the risk. That's dangerous. You got to be careful. Whenever you're dealing with money, you're dealing with risk. And the deal is you can't avoid risk. That's just a fact, right? You can only manage risk, right? And sort of control risk. And nobody talks about risk on these YouTube streets as much as they should. So what happens to most regular investors like you and me, regular people don't understand risk. And here's the deal. Once you understand risk, the next challenge is consistency. Because intelligent investing is not about perfection. You ain't got to be perfect, but it's really about discipline over long periods of time. So the fourth rule of intelligent investing is stay consistent for decades. I've been in the stock market since 1994, okay? And here's what I learned probably back in 1996 when I was first introduced to compound interest tables. And that's this. Wealth is going to favor disciplined people more than lucky people, because consistency is, in my opinion, incredibly underrated. Okay, a lot of people want this dramatic investing success without dramatic consistency. See, but long-term investing is usually what? It's slow, it takes a while, it's boring, but it's also steady because it's repetitive over and over again, right? It ain't fancy. Let's just put it like that. Let's be real. Compounding interest, it needs you to shut up, get out the way, and for you to just allow it to do the heavy lifting with your investing. The people who build real wealth are people who just keep going longer than everybody else. And one of the biggest reasons people struggle with the idea of consistency is because they start investing in things that they don't truly understand. So they panic or they change direction too often, which really takes me to the fifth rule of intelligent investing. The fifth rule of intelligent investing is simply this: never invest in things that you don't understand. Listen, if you can't explain what you're investing in a matter of 30 seconds to a minute, you shouldn't own it. I tell you what, I want you to do me a favor. Just look at all the stocks you own, if you own stocks, right? Do you know how each one of those companies make money? Do you know how each one of those companies plan to grow in the near future, next year or two? Do you know who actually owns and runs that company that you invested $10, $15, $30, $50,000 in? Do you know who owns it? Do you know what the company's competitive advantage is? Do you know what the company's PE ratio is? Do you know what their free cash flow is right now in the last quarters per se, right? Do you know how that company fits in with other companies in their sector or their market? Where do they rank? Maybe you own Walmart, Target, and some other store. Do you know if your company is number 1 in their industry or number 5 in that industry or market? See, here's the deal. What I'm trying to tell you is that a lot of people invest based on hype instead of based on information and understanding, especially nowadays with AI and these new technologies and data centers and all this. Listen, constant financial media noise and hype. People are just buying things that they truly don't understand. Let's just be honest. And that creates what? Emotions. When you don't understand something and know exactly how it works, anything can get you hyped up and anything can get you too low. It just breeds emotional investing when you don't understand the investment, because knowledge reduces risk. Knowledge reduces emotions and makes you lean on logic and rationale, right? Knowledge stops you from being nervous and scared and hyped and angry, all those emotions. You don't need to understand everything. Let me just be clear about it. But you should understand what you own. You should understand the thing that you have your $100,000 and $200,000 wrapped into. And here's the kicker. If you don't understand it, or you don't understand all your investments and all your stocks right now, but you want to invest in something or a company or stock, just learn about it. And once you understand what you own, you've done your research and you learned about it, it's going to lead you directly into the sixth rule of intelligent investing. Now, this sixth rule is simply this: diversify intelligently. See, diversification is important. I don't care what your favorite YouTuber or the article you read, you need to be diversified, right? Because diversification helps you mitigate some of that risk that I talked about. But intelligent diversification matters more, okay? Some people think that diversification means, just randomly owning a bunch of different investments. That's not necessarily true. You want real meaningful diversification. You want to have your assets or your money that you're investing in different sectors of the stock market or different asset classes, or you want to have different types of exposure. So maybe you are ETFs and index funds only. Maybe you want to have ETFs that are growth ETFs, and maybe you want to have some value ETFs, right? Maybe you want to have some ETFs that are concentrated in the healthcare sector, but maybe you want to have some ETFs that are also concentrated in the energy sector. So you want different types of exposures with your diversification. When you have concentration, too much invested in one stock or one sector, too much AI or technology, you can become overexposed in that particular sector. We know that concentration can build wealth, but we also know the lack of diversification can also destroy wealth. And even within diversification, the quality of your diversification matters also. Because here's the deal, not all investments are created equal. We got to understand that, right? Which brings me to the 7th rule of intelligent investing, and that's this: only own assets with real competitive advantages. Let me say it differently. Not all companies are created equal. Some companies have a real strong competitive advantage over others in their sector. Some have a strong balance sheet. Some companies have strong cash flow. Some companies have brand power. Some companies have scalability. Some don't. Some have customer loyalty. Some don't. See, this is what we call a moat. You want to be investing in companies, if you're investing in single stocks, that have a moat. A moat is just a competitive advantage that makes a company strong and will help that company grow over time. Let's think about Coca-Cola, right? If you set a bottle of Coca-Cola in front of 99% of the people on the planet, people are going to recognize it. You could have 2 different bottles of soft drink in front of somebody in Indonesia, right? Thailand, China, Russia, Canada, Argentina, Costa Rica, doesn't matter. You set 2 soft drinks in front of somebody, one has Coca-Cola, the other has something else on it. Most people across the world are going to heavily choose Coca-Cola because it has what we call a brand moat. It has a competitive advantage just based on the name alone. Right? Think about Netflix. 10 or 15 years ago, when Netflix subscription service for movies and entertainment came out, that was rare back then. They had, back then, a huge moat. They had a competitive advantage because they kind of kicked off the big growth of subscription services for movies, right? And what happened back then? Netflix grew like crazy. Now, since there's been a lot of other competitors come in and it sort of slowed down Netflix's growth, right? But Netflix had a competitive advantage over all their other competitors. See, sometimes an innovative concept helps a company have a strong advantage until other companies can catch up, which is what happened with Netflix, right? But mediocre companies can get exposed very quickly if there's no competitive advantage. And that's why I'm saying, when you're buying single stocks, get you a single stock or a company, invest in a company that has that moat, right? Because that's going to help them grow long term. And intelligent investors, they understand the importance of quality in a company and competitive advantage. You want to be investing in companies that have real competitive advantages, because weak businesses are going to struggle in times of uncertainty. Strong businesses with strong competitive advantages, they're going to be the ones that hang in there, okay? And finally, let's get to the last rule. This is the 8th rule, and this is where long-term investing and compounding really begin to work together. Now, the 8th rule of intelligent investing is simply reinvest dividends automatically. This is one of the quietest wealth-building tools that's out there, guys. Dividends buying more dividends, which then ultimately, eventually, buy even more dividends over time. That's compounding. Dividends compound too. I don't want, me personally, I don't want the $300, the $400, the $500 check every quarter, maybe the $1,500 check every quarter. If you do, that's cool. I'm not mad at you. But compounding is incredible when it comes to dividends. That's why I always suggest reinvest them bad boys, right? Compounding always often looks slow when you're talking about dividends until suddenly, bam, you look up and you're like, wow, okay. A lot of that is because you reinvested dividends. A lot of ordinary investors quietly can build incredible wealth simply by doing what? Staying invested, remaining disciplined, and simply reinvesting consistently those dividends over a long period of time, 10 years, 15 years, 20 years. Look, these are my 8 rules of intelligent investing that most investors, they don't think about. And that's why I say most investors are thinking about investing all wrong. Right now, we see a lot of emotion taking place in the stock market. What all of us need to do is simply slow down, follow some rules, and invest intelligently. Guys, do me a favor. Drop a comment below and let me know which one of these you struggle with the most. And let me know if you got value from this video in the comments below. Also, check out our Patreon community where we dig deeper into investing. And as always, guys, smash that like button for me. Share this video with somebody who you think needs to hear it. And remember, the absolute best person who's going to take care of that old you is the young you. Until the next video, peace.